Let me ask you something uncomfortable. What if the market rally you just watched wasn't confidence? What if it was the system flinching? On February 25th, the S&P 500 jumped 0.8%. Nvidia reported record quarterly revenue of $68.1 billion. Next quarter guidance, $78 billion. And the crowd exhaled. AI is back, they said. The rotation is on. But here's what nobody is saying out loud. And if you stay with me for the next few minutes, you'll never watch a market move the same way again. If you're new here, this channel is where we strip market hype down to the machine underneath. Hit subscribe right now, because the pattern I'm about to show you has repeated for over a century, and the next stage of it is already forming. You do not want to miss that video when it drops. Now, back to Nvidia. Here's the claim. Sharp, uncomfortable, and provable. This rally is not a signal that markets are healthy. It is proof that they are stressed. A calm market doesn't need one stock to calm itself down. A stressed market finds a coping mechanism, and right now, Nvidia is that coping mechanism. I'll prove it. And by the end, you'll be able to look at any day like this and know in 30 seconds whether it's a genuine opportunity or just the system pulling the same old lever. First, three numbers. Not to impress you, these are load-bearing. 1. Global debt sits at roughly $251 trillion. That's 235% of global GDP. That is the weight pressing down on everything. 2. The Magnificent Seven, just 7 companies, make up about 32.6% of the S&P 500, 1/3 of the entire index. 7 names. 3. Nvidia's guidance explicitly states they are not assuming any data center compute revenue from China. Growth and a geopolitical ceiling, baked into the same sentence. Debt makes the system fragile. Concentration makes the system brittle. And one company sitting at the center of the biggest capital cycle in a decade becomes the lever everyone grabs when they need to feel okay fast. Here's the systemic truth most coverage won't say. In a concentrated, debt-heavy market, the biggest stocks stop being stocks. They become control knobs. They are the places capital can move into and out of without admitting what it's actually doing. That's why these days feel like whiplash. Because they are. And it's worse now than it's ever been because you're not trading against humans anymore. You're trading against structures. Index funds that must own the largest weights. Volatility targeting funds that adjust mechanically. Options dealers hedging in real time. When enough capital is forced to do the same thing, price discovery doesn't happen. Crowd dynamics with math happens instead. So let me give you the pattern. 4 stages. It shows up across centuries, different assets, different eras, same machine every time. Stage 1 is the setup. Policy, innovation, and incentives align to reward risk. Pain gets delayed. The system trains behavior. Stage 2 is overextension. Credit expands. Stories become tradable. Leadership narrows. The winners feel safe not because they're cheap, but because they're liquid. And price becomes evidence. Rising prices stop being a result and start being the reason. Stage 3 is loss of control. A trigger hits. The system discovers it can't unwind smoothly. Liquidity vanishes exactly where it was assumed to be infinite. The market snaps. Stage 4 is the rule rewrite. Weak structures fail. Survivors get bigger. Policymakers redraw the lines. And the public gets a new story about why the new rules are necessary. Setup, overextension, loss of control, rule rewrite. Don't memorize dates, memorize transitions. That's where the machine reveals itself. Now let me prove this is real with 3 historical case studies. Same 4 stages every time. First, America in the 1920s. The setup was electric, literally. Electrification, automobiles, radio. This was genuinely transformative technology. Consumer credit grew. Buying became something you financed. Wall Street became a cultural engine. And a young Federal Reserve was trying to manage stability and growth at the same time. Sound familiar? Then came overextension. Margin buying became normal. Investment trusts multiplied, packaging speculation into something that looked diversified. The public got pulled in. The story became, we're in a new era, so old rules don't apply. Then came October 1929, but here's what most people miss. The crash was the headline. The real crisis was the credit contraction that followed. Bank failures, deflation, unemployment, global trade tightening. The system wasn't just optimistic, it was structurally overcommitted. And then came the rule rewrite. The Securities Acts of 1933 and 34, the SEC, Glass-Steagall, the monetary system itself got redesigned. The system survived by changing what normal means. The crucial lesson, electricity and cars were real. The innovation didn't fail. The financing cycle did. That's why markets are seductive. The underlying technology can be true while the pricing and leverage are completely insane. Both can be true at the same time. Second case study, the end of Bretton Woods and the 1970s. After World War II, the dollar was tied to gold, and the world rebuilt on the promise that anchor would hold. It felt stable because it was designed to be stable, the setup. But by the 1960s, the US was running growing deficits and exporting dollars abroad. Foreign central banks accumulated dollar claims. And here's the contradiction that couldn't be hidden forever. The world needed more dollars to function, but more dollars made the gold promise impossible to keep. You cannot print unlimited claims on a finite asset. August 1971. Nixon suspends dollar convertibility. The anchor snaps. Currencies start floating. Then oil shocks slam the economy. Inflation and stagnation arrive together. Bonds get destroyed. Equities suffer. Trust in money itself erodes. Here's the thing. Oil wasn't the cause. Oil was the accelerant. The real event was a monetary regime break. The rule rewrite came through pain. Paul Volcker became Fed chair in 1979. Forced rates dramatically higher, triggered recession, broke parts of the economy, and restored credibility. A new era began, one where falling rates became the background music for decades, making long-duration assets more and more valuable. The system survived by rewriting the rules of money. Third, the dot-com boom. The internet was real, computing costs were falling, and there was a growing cultural belief that central banks could smooth any downturn without real consequences. Confidence became policy adjacent. Then the overextension. Venture money poured into anything that sounded like the future. IPOs became cultural events. A new financial language appeared to justify new prices. Companies with no profits, sometimes no viable product, commanded massive valuations because the story was infinite scale and winner-take-all. The media turned founders into prophets, and the market priced prophecy like cash. That is stage 2's signature in its purest form. The story becomes a financial instrument. Then in 2000, the marginal buyer disappeared. The NASDAQ broke. The accounting scandals landed. Trust evaporated. The tech didn't stop working. The financing assumptions stopped working. And the rule rewrite, Sarbanes-Oxley, in 2002. The Fed cut aggressively. The real innovators survived and consolidated, setting up the platform giants of the next era. 3 different centuries, 3 different new eras, 3 different asset stories, same 4-stage machine. So now, which stage are we in today? Stage 1, the setup, is clearly behind us. After 2008 and again after 2020, extraordinary policy became normal policy. Near zero rates, expanding central bank balance sheets, fiscal stimulus that rewrote expectations about what governments do in a crisis. That prevented collapse. That is true, but it also trained markets to expect a floor. When you teach a system that pain will be buffered, the system takes more risk, not because people are irrational, but because incentives changed. Check. Stage 2, overextension. This is where AI enters the story, and this is where people confuse real with properly priced. AI demand is real. Nvidia's $68.1 billion quarter is not hype, it is industrial scale. But overextension doesn't mean the technology is fake. It means the market has turned one true idea into a single lever. Here's what that lever looks like in the plumbing. Trillions in passive funds must own the largest index weights. When those weights rise, passive funds buy more automatically. The benchmark dictates it. Large institutions prefer liquid names because they can enter and exit without blowing out spreads. So liquidity becomes safety even when valuation is stretched. And then options markets add a second amplifier. Traders pile into calls, dealers hedge by buying the underlying. Price moves higher. More chasing follows. More hedging is forced. The same loop flips violently in reverse on a down day. That is how you get a market where a handful of stocks can lift an entire index while most stocks barely move. 1/3 of the S&P 500 in 7 names. The market is not a debate club. It is a weighted machine. Verified. Stage 3, loss of control. In modern markets, this doesn't always look like one clean crash. It looks like repeated whiplashes. Shock, rebound, shock, rebound. The market keeps testing its own tolerance. Look at this week, concerns swirling about AI's disruption and which software models survive. Then a rally into Nvidia's earnings. Then Nvidia reports with record revenue, $62.3 billion in data center revenue alone, $215.9 billion for the full year. And then that line that should make every investor sit up. Nvidia is not assuming any data center compute revenue from China in its outlook. Growth is enormous and the constraints are explicit. That is stage 3 in one sentence. Geopolitics becomes a P&L variable. Export controls become a demand variable. Supply chains become a margin variable. Power availability becomes a capex variable. And these variables don't arrive smoothly. They arrive in chunks, in surprises, in policy memos. That is why the market feels euphoric one day and defensive the next. The environment is no longer a stable sandbox, undeniable. Which brings us to stage 4. And this is the part people most want reduced to a simple trade. Do I buy the dip or not? But stage 4 isn't a trade. It's a new operating environment. And three forces always arrive together. First, consolidation. The strongest balance sheets don't just survive, they become infrastructure. They absorb more demand, more talent, more capital. That's bullish for them. It also makes the whole system more dependent on them. Second, selectivity. Capital stops funding AI-adjacent vibes and starts demanding proof. Margins, cash conversion, real customer budgets. Companies that use the letters A and I as a marketing sticker get repriced hard and fast. Third, policy creep. Once an industry becomes infrastructure, governments treat it like infrastructure. Subsidies and restrictions simultaneously, national security reviews, export controls, antitrust scrutiny. You can already see all three inside Nvidia's own report, guiding to $78 billion while drawing a bright line around China revenue. That is growth under constraint, not growth in a frictionless world. So is the AI rotation back? In the narrow mechanical sense, yes. The system will keep rotating into Nvidia and its orbit because it's where the liquidity is, where the index weight is, where the narrative lives. But if you mean a clean, stable, broad-based rally, history says be very careful. Snapback rallies are often the most dangerous moment because they convince you the system has healed when it has only found the coping mechanism again. Here's the diagnostic. Use it after every big day. A real rotation has breadth. A pressure release has leadership. Ask yourself, did the average stock participate? Or did the index rise because a few giants did the lifting? If the move is narrow, the system didn't heal, it leaned on the valve. And if you want to track whether this is real or a repeat, watch three signals over the coming weeks. 1. Breadth. If AI is truly broadening, more industries will sustain participation, not just the same mega caps rotating back in. Narrow leadership is a warning light. 2. The price of money. AI infrastructure is expensive. Data centers are expensive. Power is expensive. If long rates stay high or move higher, the tolerance for stretched multiples shrinks. The story doesn't die, but the price people will pay for it does. 3. The capex chain. Nvidia is downstream of customer spending decisions. The moment the biggest buyers slow their orders, the market won't gently adjust. It will swing from infinite demand to capex cliff in a matter of days, because stage 3 markets reprice in chunks, not gradients. Now here's the deeper point, the one that changes how you read every headline from here on out. The real rotation isn't between AI and value. The real rotation is between regimes of credibility. When money is easy and trust is high, investors pay for future promises. High multiples. Long duration. When money is tight or uncertain, investors pay for survivability, cash flows, balance sheets, pricing power. In a concentrated index, the same mega cap can play both roles. It can be the future in one regime and the only liquid shelter in another. That is why Nvidia keeps becoming the switch. Not because the crowd is smart, because the system is constrained, and constrained systems always find their lever. Here's what to actually track instead of the hype. The price of money, rates and real yields. Concentration. Are the same few names doing all the work? Credit spreads. Are they tightening because confidence is real, or because liquidity is forcing risk on? And geopolitical and regulatory signals. Export controls, antitrust, industrial policy. Anything that can override pure demand. If constraints are tightening, don't treat a rally as permission to be careless. Treat it as a volatility gift. Reduce leverage. Keep liquidity. Don't confuse "I can trade this" with "this can't hurt me," because the punishment in this phase doesn't come from being wrong once. It comes from being wrong while overexposed, in a system that can gap against you before you can even process what happened. This time is different, is the oldest lie in finance. It always comes in flattering costumes. It comes as American exceptionalism, as central bank confidence, as tech salvation. AI can genuinely transform productivity, and the market can still wildly overpay for it. Both can be true. They usually are. So here is the map. One sentence. Write it down. A debt-heavy, concentrated market cannot digest uncertainty evenly, so it discharges uncertainty through a handful of mega-cap pressure valves until a constraint forces a rule rewrite. That is the machine, and the people who survive it are not the ones who called the top. They are the ones who understood the machine before it demanded tuition. If you want the next layer, how passive flows concentrate risk, how options hedging amplifies moves, how buybacks create structural bids, how geopolitics turns supply chains into policy weapons, that video is coming next. Subscribe and hit the bell so you don't miss it, because the next stage of this pattern is never announced in advance. It just arrives.